Hi everyone, and welcome to the Digital Asset Report, the show that focuses on digital assets, blockchain, innovation, and disruption in the financial services sector. I'm your host, Rachel Pather. Joining me today is Ebrahim Ebrahim, founder and CEO of Fintech Robos, a company that is digitizing savings and pensions. Ebrahim, welcome to the show.
Thank you, Rachel. Thank you so much. I'm very pleased to be with you.
No, we're really excited to have you on. You know, I've known you for a number of years now, and you have this self-confessed passion for pensions. What drives this?
Yes, I can't deny this. I'm really driven by this industry, and those surrounding me have noticed it as well. I guess there was a bit of historical coincidence that destined me for this sector. Like exactly 20 years ago, I was head of marketing at the Arab insurance group, ARIC, which at the time was the largest insurance and reinsurance house in the MENA. And there was this private pension product lined up as part of an aggressive business expansion for the group. But in the same year also, the 9/11 attacks on the US happened, involving 4 planes. ARIC was one of the insurers of the both American Airlines and United Airlines, whose planes were involved in the crash. Hence, we got a strong hit on our balance sheet, and our financial security as an insurance business was severely impacted. Therefore, the project was abandoned, amongst other things. At the same year also, we wrote an 8-page theme paper around how pensions work and challenges to the sector as part of an industry flavor that we include in the group's annual report. Every year, a different theme is chosen, and that made me read and research a lot about pension for the first time. Relatively early in my career, and since then, the more I learn about pension, the more intrigued I become. In 2012, as I took a brief early retirement after a 12-year stint in the UAE telecom sector, I was headhunted to work for the first financial institution set up in the region to provide long-term savings and pension. Established by KIPCO. KIPCO is a very leading and distinguished diversified business holding group in Kuwait, but in the entire MENA region. And coincidentally also, that business was led and built by my ex-colleague who was supposed to launch private pensions at ARIC. His name was Lakhdar Musi. So that's on my career event. So the beginnings for me to get this connection with pension was very much in the first 15 years of my life. I would say on the ideological financial level, I'm troubled by people's lack of financial literacy and discipline in the space of personal finance. The culture of financial planning is almost absent among the majority of the MENA populations. A large number of people do not save money, and the majority do not know the basics of proper savings, such as the difference between the short-term and long-term savings, and the impacts of inflation, and how to choose products that maximize returns on personal savings. So the vast majority of citizens make their long-term savings through cold bank accounts. I mean, they are not invested, with money enticed by raffle draws launched by retail banks. And this really proves that they aren't aware of the importance of the appropriate return on their savings, and unfortunately rely on lottery-like ways of building their financial resilience, where 99.999% of people do not win in these raffles, as you know.
Yeah, so Ebrahim, let's then look at innovation in the pension space in the region, because you've obviously been working in this for quite some time. Where do you think the region as a whole stands in terms of pension innovation?
That's a great question, Rachel. The answer in short is, as a region, we're not doing enough. We're not moving fast enough, to say the least. Pension has been one of the neglected and forgotten sectors in the MENA region, despite its significance for the people's livelihood and social stability for any nation, as you know. Looking at the concept of pension as we know it from a historic perspective, one might be tempted to think that pension was a nice and interesting idea when by and large relatively prosperous countries came up with, when they were busy being more prosperous, and they were able to do that anytime in an environment where their working age population was growing and more money was coming in. And the promises by and large were easy to make and relatively easy to keep. What perhaps we all didn't bank on at the time, that with this prosperity, pension systems will end up with more pensioners who would typically lead longer lives with all the health improvements. And with time also, they will end up with fewer working age people, which in time will, of course, upset the original calculus of the architecture of these government pension systems. Therefore, globally, and including in our region, state pensions have become something of a ticking time bomb now. Here in the Gulf, the story was a little bit different because all of this was underwritten by what at the time seemed to be an infinite petroleum wealth of these countries. Most of the regional pension systems emerged in the 50s, 60s, 70s at the time of the oil boom. But what we've come to realize since then is that while population and fiscal expenditures went up, oil revenues have not necessarily kept pace. The Gulf is not different from the global norm. So in terms of these state pension running substantial actuarial deficits, where the region is perhaps different from the advanced countries is that it doesn't necessarily have much of an institutional framework for pensions apart from these state or government pension funds. There are relatively fewer structured and regulated alternatives to state pensions. So what we've done in response to this is what everybody else has done, tweaking these funds and with something that is called parametric reforms, creating asset managers for pensions to enhance returns, etc. So at their basic level, government pension funds need to achieve financial balance, as you know, a balance between the total of contributions and investment returns on one side and the total of benefits paid to pensioners on the other side. So parametric reforms are targeted adjustments that aim to preserve these funds and make them financially robust. And they include any or all of these options. Pushing the retirement age, we push the retirement age to later years. We reduce benefits or increase contributions. And none of these options is a hugely popular choice, as you know, politically and socially. Beyond these tweaks, our region, as I said earlier, isn't doing enough to address the issue. And hence the trouble isn't going away. And it's not about to go away. We are in a situation of huge funding gaps. The world is using multi-pillar system. And here in the region, we are using a single gear system that is also utilized, unfortunately, for several purposes, such as means-tested, occupational, and also because sometimes governments need to achieve financial rebalancing and cut costs, so they push thousands of employees on voluntary early retirement. And this single pillar of state pension has to cater to all these government needs and expenditures. And when public debt in some countries exceed 90% of GDP, it's very unlikely that governments will be able to recapitalize pension funds whose actuarial deficit is already bigger than the country's total GDP. Hence, my advice to governments in the region is two things. First, start building a savings economy. Right now, we are very much into a consumer-led economy, especially around pension savings. And the second thing is start diversifying pension savings beyond government funds, maybe DC pensions being a prime example. And my advice to the MENA citizens is that your future pension is somehow unfunded. Your future pension is somehow an unfunded liability, and you'd better be working on your financial resilience by starting to save. That's my answer.
No, definitely. And it does seem that there's a ticking time bomb in some of these pension schemes in the region. So let's move to Fintech Robos now. Tell me a bit about the company and what are some of the challenges that you're looking to solve?
Well, as you know, or probably you have researched, we are a B2B Fintech company. We provide the clients with white label technology for savings, investment, and pension services. We want to build a trusted, purpose-driven regional house of fintech solutions for long-term savings and pensions, because I think we believe there is a large potential unaddressed in this space. And the company itself is a product of several experts pulling together to revolutionize how financial planning and investment operations can be digitally managed. We also pride ourselves on being the first and only GCC-originated fintech innovator in this space, and serving the needs of local MENA financial and corporate institutions. Importantly, Rachel, we aim to be part of the solution to the region's chronic pension funding. We would like to be part of the solution to the region's funding conundrum, and we will do so by filling the current gap in technologies and admin services available that allow the pension, that allow the provision of both personal and contributory pension plans. We're also proud to contribute to the positioning of the Kingdom of Bahrain and the wider Gulf region at the global forefront of fintech adoption, in line with the region's 2030 vision for a seamless digital economy. Our technologies are a nice and dynamic digital complement to MENA region institutions that help individuals and families with financial planning, encourage people to save for the long term and save in optimal ways, support people's retirement with private pension saving, and also institutions who require tools and software that serve the pension savings for individuals and corporations. We also act as a conduit between the world of investment and the world of savers.
And so given, you've basically come about, I wouldn't say because of the pandemic, but you've had your formative years for the company during the pandemic. How do you think COVID has driven innovation in the pension space?
Actually, COVID has affected almost every single dimension of the pension formula. So first, it has affected contribution in the sense that there has been increased job losses, increased millions and thousands of people going on early retirement. It has driven higher unemployment, death cases. All of this is so bad on the contribution side of the pension. If you go to the investment side of pension fund, investment returns typically contributes to 2/3 of any fund assets. And in 2020, it's not that pension funds lost the returns, but also lost significant part of their asset value. It even also affected the forward rates of return. Third, if you look at the the pension benefit itself, there is a short-term shock and long-term uncertainty around funding and sustainability of pension funds. So to put it into context for you, global pensions have been exposed to successive storms, represented by a sharp decline in stock returns in the year 2001, followed by a decline in bond yields in 2002, and then the future further deterioration of bond rates after the financial crisis in 2008. And then the start of a quantitative easing. Hence, funding levels of pension funds administered by the world's 1,500 largest companies decreased, and also to a great extent, state pension fund also decreased by more than 40% on average. Here I'm talking about the first 2 decades of the current century. And in the process, very few pension funds around the world have previously conducted a stress test on the dual effects of declining stock and bond returns together before this crisis. And I also bet you, with this COVID, I bet you none of them have done a stress test that also measures or mitigates the impact of a potential pandemic that upsets the basic functioning math of a pension system. So hence the COVID-19 shock has certainly added a whole new major dimension of risk that the pension industry will need to factor in going forward. In order to understand the magnitude of surges in pension costs, you have to realize that the nature of these obligations is very long-term ones, reaching 50 or 70 years in the future, meaning a large percentage of the young men or women joining the labor market in the year 2020 may live for the year 2070, 2080. Therefore, only 1% of compound increase in the annual cost of a pension fund, say starting in the year 1990, has a negative impact of increasing pension obligations by 34%. And a 1% compound decrease in the investment returns from the year 2000, for example, has a negative impact of 21% increase in the pension obligation. So that's why globally the issue of financing pension deficit has not been resolved yet. And pension liabilities, although similar to bonds and debt instruments, are however far riskier in financial terms because the liability, because of the inability to hedge them, and although they are similar to a bond coupon, the tail of these obligations and their legal structure is much longer and much more complex. Hence, if COVID-19 were to be a nudge in the pension space, it would certainly be for a strong message that uncertainty is increasing in the world rather than decreasing, and thus retirement security cannot be built resiliently on the single pillar of state pension funds, but on a diversified framework that includes employer-based and a private pension savings vehicle.
No, that's great. That's an excellent overview. Thank you, Ebrahim. As someone that's lived in the region for a while, I know that this area is definitely in need of a large overhaul. So thank you so much for your time today and for coming on the show.
Thank you very much, Rachel. Thank you so much. I appreciate it.